The latest developments surrounding the United States labor market and the federal government's reaction to revised employment figures have triggered concerns that reach far beyond monthly statistics. They reveal a deeper conflict between political control and institutional independence. On the surface, the data released by the Bureau of Labor Statistics in early August 2025 appeared routine, but disappointing. The agency reported that the United States economy had added only 73,000 jobs in the preceding month of July. But what followed reshaped the story entirely. Revisions to the prior 2 months, May and June, reduced net job creation during that period to merely 33,002, a downward adjustment of more than 250,000 positions. These figures represent the slowest hiring momentum seen since the pandemic-induced downturn. But the true rupture came not from the data itself, but from the political response that ensued. Within hours of the report's release, President Donald Trump dismissed the commissioner of the Bureau of Labor Statistics, accusing her of manipulating job figures to damage the Republican Party. The president posted publicly that, in his view, the numbers were rigged. This reaction marked a stark reversal from previous months, during which the president had frequently praised strong job numbers and cited them as evidence of his administration's economic stewardship. The commissioner in question, confirmed by a bipartisan Senate vote just a year earlier and supported by Republican lawmakers such as Senator J.D. Vance, had been expected to serve a full term through the end of 2028. Her role, like that of other statistical agency heads, was intended to be apolitical, insulated from the pressures of any one administration. The president's action, while legally within executive authority, raises structural questions about the independence of economic data in an era of intensifying partisanship. The Bureau of Labor Statistics does not only publish employment figures, it also produces inflation data, import-export indexes, and other economic indicators that form the backbone of decisions made by the Federal Reserve, the Treasury Department, and private sector institutions worldwide. The removal of its head amid accusations of political bias, even without concrete evidence, sends a message that data integrity may no longer be immune to political intervention. That shift has already generated consequences. Markets reacted with a sharp pullback across major indexes. Economists voiced concerns about the objectivity of future reports, and political figures across the spectrum responded with alarm. Senator Lisa Murkowski of Alaska publicly criticized the move, stating, "When you do not like the message, you fire the messenger." The White House defended the decision, arguing that the president should not be forced to retain an official appointed under a prior administration. But this argument misses the point of institutional design. The terms of agency commissioners are deliberately staggered to ensure continuity and to guard against precisely this kind of political disruption. The data itself remains troubling. Economists interviewed across multiple outlets agree that job creation has slowed to stall speed. While net employment is not yet declining, the deceleration pattern mirrors historical preludes to recessions. The revised job numbers align with an economy operating under strain not from consumer weakness, but from overlapping forces. Tariffs, interest rates, and shifting corporate confidence all converge in this moment. On the same day the employment report was released, the Trump administration finalized sweeping new tariffs on dozens of United States trading partners. If fully enacted, they would raise trade barriers to their highest point since the Great Depression. This economic tightening, layered atop fragile labor growth, creates a complex policy environment. The Federal Reserve, which had just announced a pause in interest rate hikes, now faces renewed pressure. The president intensified his public demands for rate cuts, and markets began to price in an 80% probability of a reduction in September. At the same time, Federal Reserve Governor Adriana Kugler unexpectedly resigned her post, removing one of the institution's most experienced voices at a moment of heightened uncertainty. The simultaneous politicization of the Bureau of Labor Statistics and the increasing pressure on the Federal Reserve raised the prospect of institutional fragility. Once public confidence in data generation and monetary independence erodes, so too does the ability to manage economic cycles effectively. Former National Economic Council Deputy Director Everett Eisenstadt, speaking on national television, acknowledged that while he had seen no direct evidence of wrongdoing, the president's frustration may stem from broader political and economic friction. In his view, the White House had scored multiple policy wins on tax cuts, deregulation, and tariffs, yet continued to be undermined by data that conflicted with the administration's economic narrative. But that explanation does not resolve the underlying contradiction. If the same statistical institutions were previously celebrated for strong numbers, what changed when the numbers weakened? The answer lies not in evidence of data fraud, but in political optics. It is easier and perhaps more politically expedient to discredit the source than to revise the message. Yet doing so has consequences. Investors do not respond only to policy. They respond to predictability, rule of law, and institutional reliability. The potential perception that economic data can be altered or dismissed based on political discomfort will reverberate through boardrooms, central banks, and foreign ministries across the globe. The United States dollar, still the dominant reserve currency, relies in part on the credibility of the institutions behind it. Weakening that credibility introduces long-term risk. Allies and adversaries alike are watching. In Beijing, Moscow, Brussels, and Tokyo, strategic analysts will view these developments through a wider lens. For them, the question is not whether the United States can create jobs in any given month. It is whether the political system can be trusted to report them honestly. For decades, the strength of American economic influence has rested not only on size or growth, but on transparency and trust. That equation is now being tested. If the Bureau of Labor Statistics is seen as a political instrument, and if the Federal Reserve is perceived as caving to presidential pressure, the consequences will unfold quietly, but inexorably. Capital will become more cautious. Foreign central banks will diversify their exposure, and domestic business investment may delay key decisions. Even if the data manipulation claims are unfounded, the signal has been sent. The president is willing to replace officials who produce inconvenient outcomes. The next appointee to lead the Bureau of Labor Statistics will likely face dual pressure to restore credibility among economists, while also satisfying political expectations from the executive branch. That tension is unsustainable in the long term. Meanwhile, recession risks remain elevated. Economists differ on timing and severity, but the consensus is that continued weak job growth, compounded by trade shocks, could tip the economy toward contraction. Monetary policy, which might otherwise respond flexibly, now carries political baggage. Any rate cut in September will be interpreted not just as a technical decision, but as a capitulation or defiance. The danger is that economics becomes narrative, and narrative replaces analysis. That is not a sustainable model for a global superpower. The long-term challenge now facing the United States is not simply to create more jobs, but to preserve the credibility of the system that measures them. That credibility, once lost, is difficult to regain.